You find the perfect house. The listing says $300,000. But that price tag is not your real monthly cost. The surprise for many buyers is the true cost. A mortgage is a massive financial commitment. A mortgage is a loan secured by your home. The listing price is just a starting point. You pay cash up front to close the deal. Then you make a monthly loan payment for decades. You also pay other ownership costs every month. Your specific loan terms define your financial risk. If you cannot pay, you could ultimately face foreclosure. We are going to trace the full payment, explain amortization, and compare written offers. We will show you how to look past the advertised rate. Let us look at what makes up your bill. Start with an example. Purchase. Imagine a $300,000 home price. You put $60,000 down. That leaves a $240,000 loan. Your loan amount is the starting balance. The part you still owe is called principal. Interest is the fee charged for borrowing it. Principal and interest are just the start. Your monthly payment parts often include much more. A common shorthand is PITI. The first part is principal. The second part is interest. In this illustration, principal and interest together are $1,500. You also pay property taxes. Use $350 here. Finally, you pay homeowners insurance. Use $150. A lender might collect property taxes and homeowners insurance for you. You might also pay mortgage insurance. If that adds $100, the example total becomes $2,100 a month. This depends on your down payment and loan program. Its cancellation rules are not identical across all loans. Association dues usually sit outside the mortgage statement, but they still belong in your budget. Your total monthly payment combines all these required costs. Cash to close is a totally different number. It includes your down payment and lender fees. It also includes prepaid interest and initial escrow funding. So never trust a basic online calculator. Add up every housing cost first. Next, we will solve the mystery of escrow. Some loans use an escrow account. Escrow accounts are very common for first-time buyers. The lender must estimate your future bills for the year. Then they collect a monthly share with your mortgage payment. If annual taxes and insurance total $4,800, that monthly share is $400. They hold the money in a special account. When the bills are due, they pay tax and insurance bills for you. Escrow stops you from missing a massive payment. But it is not a price lock. Your servicer will analyze the account for a shortage or surplus every year. If property taxes or insurance premiums rise, your required escrow portion goes up. A shortage from last year might be billed over time. A surplus might be refunded to you. It does not mean the underlying bill disappeared. This is how a fixed interest rate can still mean a changing monthly payment. Read every escrow statement carefully. Verify that your insurance was paid to the right company. Compare the projected taxes with your actual bills. Let us see how your actual loan balance shrinks. Amortization is a powerful financial concept to understand. Amortization is the schedule that shrinks your debt. Let us look at what amortization means for your wallet. On a fixed loan, your core payment stays level, but the split between principal and interest changes. Your interest comes from the remaining balance each month. Early on, that balance is huge, so early payments contain more interest than principal. Picture a purely illustrative $1,500 principal and interest payment. An early example could show $1,050 of interest and $450 of principal. As the balance falls, the interest charge drops. That means later payments contain more principal. A later illustration can reverse those shares. $450 of interest and $1,050 of principal. The exact split depends on your rate and term. It is not a universal percentage. Taxes and insurance sit completely outside this curve. An extra payment lowers your future balance, but it usually does not reduce your next scheduled bill. You have to use the exact loan schedule to see the math. Your amortization table shows the month-by-month result. Do not guess from a generic graphic online. Now, how do you know what you can afford? A house comes with many hidden costs. Affordability has two different answers. One is what a lender approves. The other is what you can comfortably carry. First, check the lender debt test. This compares your monthly debt to your gross income. The old 28 and 36% rules are just guidelines. On $8,000 of gross monthly income, 28% is $2,240. That is an illustration, not a universal approval limit. Your personal budget must go further. Second, build from your take-home pay. Subtract the cash needed at closing to protect your savings. If you have $80,000 and need $65,000 at closing, $15,000 remains. Third, add every housing cost together. This includes ownership costs outside the loan like maintenance. Use a $500 monthly example for maintenance, utilities, and HOA. Fourth, subtract normal life expenses like groceries and childcare. In this example, those priorities use $1,800 a month. Fifth, stress test the household budget for taxes and insurance. Raise the $2,100 pity example by 10%. The stress payment is $2,310. Could you handle that higher bill or a broken furnace? Add a future income test too. Could the payment survive a temporary job gap? Finally, protect an emergency reserve of cash. Do not drain your bank account for the down payment. Pre-approval just tells you what a lender might offer. It does not mean the payment is safe. Next, we will look at loan types. Your loan term decides how quickly you pay. You must choose your rate structure carefully. A 30-year fixed loan keeps your interest rate unchanged for 3 decades. A 15-year fixed loan requires a higher monthly payment, but it can save you thousands in total interest. An adjustable rate mortgage has a fixed rate at first. Then the rate changes based on a financial index. Do not call an adjustable rate cheap until you know the maximum possible payment. Program labels matter too. On our $300,000 example, a conventional loan with 20% down uses $60,000 up front. An FHA loan can require as little as 3.5% down. That is $10,500 on the same home before closing costs. Eligible VA borrowers may have a zero down option. Eligible USDA buyers in qualifying rural areas may also have zero down financing. A jumbo loan is simply above the local conforming limit. In most of the country, the 2026 one-unit baseline is $832,750. High-cost counties can have higher limits. These program rules and fees can change. You must compare written loan estimates to find the truth. Look at the interest rate, APR, and cash to close. You might also pay a discount point cost to lower your rate. 1 point is usually 1% of the loan amount. Divide the upfront fee by your monthly savings to see when it pays off. APR is useful, but it is not everything. Let us talk about changing your loan later. Extra principal can shorten your loan and reduce interest, but check for a prepayment penalty first. Do not drain your emergency fund just to make the balance look smaller. Refinancing is a totally separate decision. A refinance means starting the loan process over. Start by checking current interest rates against your current loan baseline. Then review the new loan terms. You must estimate your new closing costs for the deal. Divide those new closing costs by your reliable monthly savings. This helps you calculate a break-even point. That is your basic break-even time. Finally, compare this to your timeline for staying in the house. $4,000 in costs divided by $200 in savings takes 20 months to recover. But that is only a first screen. It ignores the time value of money. It also ignores the effect of extending your payoff date. Compare the new loan against keeping the old one. With cash-out refinancing, your credit card spending becomes debt secured by the home. That makes the risk materially different. Finally, how do you pick the winning offer? A loan estimate is a standard legal document. Ask multiple lenders for official loan estimates. Compare them on the same day using the same assumptions. First, check the interest rate and lock expiration. Then look at the projected total monthly payment. Suppose offer A shows $2,100 and offer B shows $2,050. Do not just look at principal and interest. Next, find the estimated cash to close on the first page. Suppose A needs $65,000 and B needs $68,000. Finally, turn to the comparison section for the 5-year cost. In the simple example, B costs $3,000 more upfront but saves $50 a month. 3,000 divided by 50 is 60 months before the extra cash is recovered. The official 5-year comparison also shows what you will pay in principal, interest, and fees over 60 months. Watch out for risky loan features like prepayment penalties or balloon payments. Points can reduce your rate by charging more upfront. Lender credits do the reverse. Neither is automatically better. Match the structure to how long you will keep the loan. Before closing, compare your final closing disclosure against the loan estimate. Ask about every single change. Keep your note and closing documents in a safe place. Servicing can transfer to another company. Verify every transfer notice before sending money. If a payment problem appears later, contact your servicer immediately. Ask about available loss mitigation options. The safest move is early contact and written records. Understanding your mortgage keeps you in control of your biggest asset. You now know exactly where your monthly payment goes. You can compare offers and find the best fit. Do not let the paperwork intimidate you. For a free, personalized home maintenance plan that helps protect that investment, check out the I Am Home app, and you can read our complete in-depth guide to mortgages at the link below.